Daniel, you do life insurance. Tell me, what's the best policy I should buy? Well, asking a question like that to me is like asking a doctor, hey, we just met. What procedure should I get? There's so much more information that has to be gathered in order for them to actually be able to help you. And one of the challenges I see online all the time is people are selling life insurance. They're creating this frameworks for people to say, okay, always do this, never do that. You always want to get this type of policy. You never want to get that type of policy. And they're trying to serve people with the type of life insurance they help with. The problem is consumers are being torn. They don't know what to do and they're getting confused. And it's very, very hard for somebody who's not in the business to be able to discern what's the right path for them. So in this video, I'm going to break down 5 key frameworks that you can use for different types of policies to be able to help give you some guidance as you're learning about life insurance online. So the 5 key frameworks I'm going to go through are going to be term, whole life, IUL, MEC, and hybrid. We're not going to touch variable universal life. That has its place, but I'm not going to go into that in this video. You need a specific type of license to be able to offer variable products, which I do not have. And so I'm going to focus on the 5 that I'm competent in. For variable universal life, there's some great advisors that hold those licenses that can help you with those. But we're going to focus on these 5. So as you're learning about life insurance online, you have a basis for understanding so you can decide when you're hearing these things, who's helping you the right way. So number 1 is going to be term. Term is simple. It's renting insurance. It's the insurance you get when you need to protect yourself from financial risk of losing a loved one or a breadwinner. That's important when your kids are young, when you have a lot of expenses, when you have a lot of debt, when you have somebody as the primary breadwinner, when you have anybody that would be impacted by the loss of that person. It's literally just insuring their life, the primary focus of life insurance. And basically the way it works is you pay a premium for a certain term, you get a lot more death benefit protection than any of the other types for the same amount of money. But again, when the term is up, the insurance goes away. Now, some term policies have the ability to have return of premium where you get every dollar back that you put in. Some policies have the ability to convert that policy so you can keep it going into some other type of insurance. And sometimes you can even sell your term insurance. Now, I'm not saying that any of those are the best course of action. I'm just saying the primary focus of term is going to be, I want to pay the least for the most benefit because I need the protection. There's too much financial risk if this person were to pass away suddenly and their income were to be sucked out of the equation. That's what I want you to focus on when you're thinking about term. That's its main goal. Number 2 is going to be whole life insurance. Now, whole life and IUL are this kind of like tug of war online. There's always like IUL people, there's always whole life people. I'm neither, and I'm not in the middle. I think these are all tools. Like, I really truly believe that each one has its purpose. I don't personally believe that there's a boardroom full of executives at an evil insurance company sitting around going, we're going to trick all these people to buy our policy and then we're going to screw them over. I just don't think that's happening. The proof that they all have a purpose is they all exist and they all do different things and they all serve different needs. So again, whether one's priced better than another or one has more benefits than another, companies are trying to compete in certain areas, that's where you're going to need to work with an independent agent to figure out really what's going to provide you the best benefits for your individual unique circumstance. But again, I'm not in that tug of war. I use whole life, I use IUL. Now, I'm going to give you the framework for both. So with whole life, the only time I'm using whole life insurance, and this is what I own personally, is when I have the ability to maximize a certain result or multiply wealth. That's going to be the only time I use it. Okay, so for example, I have clients that are very big into real estate or growing businesses. Real estate and businesses are great ways to multiply your wealth when done correctly. And if you have experience in those fields, whole life insurance can be a great place for you to be able to use as a foundation for those other activities. That's how I use it personally, and that's how other people use it. Now, let's go over some statistics. 90% of America makes less than 100 grand, and 1/3 of America wouldn't be able to handle a financial emergency of more than $1,000 a month and is living paycheck to paycheck. They are not investing in real estate or businesses or multiplying wealth. They're trying to get by. So would that be the appropriate policy for them? No, it most likely would not. And in fact, it wouldn't. And I wouldn't use it that way. It's only for a certain segment of people. Now, it's for people who have the ability to multiply and grow their wealth. And this could be a place where they can leverage some of that cash value while they're getting life insurance death benefits put in place. And those cash values that they use properly through loans will over time build future potential dividends for them down the road. That's how I use whole life insurance. That's it. I'm not using it for any other circumstance or any other reason. There's all other kinds of reasons you can use it. But again, in this video, I'm trying to give you short, simple frameworks that you can take with you and use as you're evaluating all these different people online to see if they're going overboard or if they're going too far or if they're misleading you. You want to just be able to discern who's who and what you can use each type of policy for. So again, whole life is going to be, in contrast to term, it's going to be more expensive for the death benefit you're buying, of course. But again, you're overfunding it so that you can use that cash value for other activities that you can do to multiply your wealth. Okay, let's move on to IUL. This is the hot button right here. So IUL, I'm never using in the accumulation phase. So again, one of the ways I want to break this down is by age 60. So before age 60, I'm going to be using term and I'm going to be using whole life insurance. Now, I use whole life insurance after age 60 as well, all the time. But I'm using whole life and term in the accumulation phase. This is when you're saving for retirement, you're building, you're getting to age 60. 60 and up is when I use IUL. And now some people might think that that's weird, but I don't use it for people under age 60. I use it for 60 and up. And when I do an IUL, I'm only looking for 2 ways to use the IUL. I am never looking to overfund an IUL to take like income from it or loans. That I don't use it that way. I think there's too many moving parts. I think there's a lot of risk, and I don't feel comfortable using it in that capacity. What I do use it for is for modified endowment contracts, which I'm going to talk about next. And I use it for when an IUL has a strong guarantee. So when that illustration on an IUL has a strong guarantee and we are only buying it for benefits, which is what life insurance is for, the death benefit or an accelerated death benefit rider, which means part of that death benefit is going to come to you while you're alive if you have a qualifying care event. Those are the only 2 times I'm using it, okay? So I'm not overfunding it the way I'm doing with whole life, other than when I MEC it, and I'm going to get to that next. But I'm mostly using it for benefits. And even when I MEC it, I'm primarily using it for benefits. That's its function. So what that means is, let's say somebody is age 65 and they want to get a benefit, a death benefit to protect their family that they have for the rest of their life. Well, an IUL with a strong guarantee, or sometimes even referred to, and sometimes even the product can be what's called a GUL, a guaranteed universal life. That's where you can buy a death benefit for a premium, and a lot of times you can get better leverage than using whole life when you're just focused on benefits. So that's a great place. Like if somebody says, okay, I want this death benefit, I want it to be there, I want to pay the premium, get the death benefit, no performance, I just want the benefits for either for care for me or a death benefit for a loved one, that's where I'm going to be using IUL. Now let's move to the 4th framework, which is MEC, because MEC is confusing. A lot of these people online say, oh, we always make sure we don't MEC, we never MEC, right? Again, let's keep it in the framework. There's the accumulation phase where you would not want to MEC. There's penalties if you MEC your policy and then use the loans from it before age 59 and a half. There's 10% penalties. After age 59 and a half, so again, 60 and up, is where you can have a MEC. This is a modified endowment contract. And all a MEC is basically a different tax status for your life insurance policy. It means you overfunded it to the level of you put more cash in relation to death benefit, and the IRS says you can have tax-free loans. So another way to say that is you put so much in so fast that it actually passed the MEC limit, and now the loans that you take are going to be taxable loans. People will say, well, that's dumb. Why would you do that? Again, I work with people in retirement, 60s, 70s, 80s, 90s, centurions, right? If I have a 75-year-old who says, man, I don't have anything in place for long-term care. Well, we can set up a MEC. They can take some assets like they have in CDs or potential excess savings. Again, this is excess above what they need to keep in their liquid reserves, well above that. And we can put it in a MEC. And what that means is we can basically put some special riders on where they can have return of premium. And so they can take all their money back at any time, whenever they want. So depending on how, it doesn't really matter how it performs, because if they ever wanted their money back, they can take it out for that purpose. Now, it matters how it performs because that's going to, relate to how much benefit they get. But again, if they want all their money back, they can take it out. If they don't want all their money back and they want to keep it in place for those death benefits or accelerated death benefit riders, well, then it's a place where you can store that premium. You can take it back if you need, but it's going to have death benefits and care benefits associated with it. It's a very powerful way to be able to set something up, but be able to keep access to that money in case you change your mind and need it. So that's where I'm going to be using the MEC. It's basically an overfunded, typically single premium policy. You can do a MEC over multiple payments, but this MEC is going to be for people who are 60 and up and who want benefits, okay? So my IUL framework and my MEC framework are pretty closely related because they're strictly for benefits. One for IUL is saying, hey, I want to get the most benefit I can for the guarantee. The MEC is going to say, hey, I want to keep this capital available in case I need it back, my premium, through this return of premium rider or waiver or surrender rider, but I'm going to have these other benefits. So that's going to be for age 60 and up. And the last one is hybrids, and I do a lot of hybrids. Hybrids are like they took a long-term care policy and a life insurance policy and put them together. So you're going to get a death benefit, you're going to put in a premium, you can put all kinds of riders on these hybrids, return of premium, waiver, surrender. Sometimes you don't even need them, the premium will just kind of sit there. Or sometimes you can say, I want the most benefit possible and have less access to premium. But again, these are going to be for people in their 60s, 70s, 80s, is really the age they go up to. And you're going to be able to have a death benefit that's also a true long-term care benefit. So it's a great way to have kind of what they call a linked benefit or dual benefit. It's a death benefit, but it's also long-term care. And so this is where you can really do a better job. So a lot of people might go back to my third framework with the IUL and go, well, hey, I thought you put a rider on your IUL where it's accelerated death benefit rider. That's true, but that policy is geared more for life insurance and care is like an ancillary benefit. The hybrids are kind of the opposite. Long-term care is really the primary focus and death benefit's kind of the ancillary benefit. So they all serve their place and they all have a good role in making sure to help you. Where people get really tied up and confused is they get in these kind of battles of like, oh, non-MEC, MEC, IUL, whole life. Again, you got to keep it simple. Term is for renting your insurance. Whole life for me is to help me maximize an opportunity to multiply my wealth and have that be kind of my foundation. IUL, I'm going to use strictly for benefits. MECs, I'm going to use to be able to hang on to my principal, but also have benefits. And hybrids are going to be purely for care benefits, primarily, with a death benefit attached. And that's it. I mean, that's how simple we can keep these different frameworks for life insurance. So you can now use those as a tool as you're watching content, talking to some of these agents. You can decide, okay, well, where does this fit into these frameworks? Am I in the accumulation phase and I'm looking at term and whole life? Am I under age 60? Or am I over age 60? Am I looking at benefits, IULs, MECs, and hybrids? And those are going to be kind of how I can kind of give you a framework. So I want to keep it simple. I want to keep it relatively short for each one so that you had a tool to be able to use. If you want more information on MECs, a lot of people have questions on those. Check out this video here. I want to say thanks so much for watching, and I hope to see you really soon.